this is basically a direct intervention in the market, where the central bank steps in as a participant. He is either a buyer or he is a seller, depending upon what the market conditions are. If the market has excessive demand, you sell. If the market has excessive supply of foreign currency, you buy, right? Now, to be able to do that, a central bank needs to have reserves, right? Because if I don't have reserves, then how am I going to take care of the excessive demand that may happen, right? And invariably in the emerging market economies, you end up in a situation where there is excessive demand than excessive supply of foreign currencies. Many a times you may not have sufficient reserves, right? And the market may be excessively on one side, particularly in the scenario where the currency is weakening a lot. And in that case, what you do is you basically then start restricting either the participants who can buy and sell, or the purpose for which you can buy and sell.
Right.
Right? So, at the heart of managing a managed floating exchange rate regime is intervention by the central bank, coupled with what we call as capital controls, if the intervention or the size of reserves is not good enough for you to be able to manage the market. So, it's a combination of these two things.
Understood. So, Neeraj, does then a fully floating currency mean that there is no intervention by the central bank?
For most part, yes, there is no intervention in the central bank. But there can be instances and situations, though it happens very rarely, that a central bank is forced to intervene even if the currency is fully convertible and it's a fully market driven exchange rate. Take the case in point of Japanese yen now. It has depreciated to 150 yen to a dollar over the last, I think, about 18 to 24 months. This has been a very rapid depreciation of JPY, and there is this expectation that if yen was to depreciate a lot, and it is already reaching the threshold where there could be a potential for Bank of Japan to intervene and stem the pace of depreciation of the market, right? There have been very few instances in the recent history, say about last 20-30 years, where Bank of Japan has intervened in the market. So, when something like this happens, it's a rare instance that Bank of Japan has intervened and that has a big influence on the markets, but it is not impossible, right? For most part, for a very large period of time, it can be a fully market driven, exchange rate establishment that can happen.
Understood. And so, Neeraj, how do central banks think about the exchange rate itself? So, as an example, how does the RBI think about the rupee, and is a depreciating rupee better or an appreciating rupee better? Or many times you hear this, right? Like, oh, our exchange rate has depreciated, it is bad for the country or whatever. So how do central banks think about it?
See, in some senses, it's a price. A currency exchange rate is a price, right? And depending upon how the price is set, it will have an impact on the demand and supply of the goods in the economy, right? So, take the example, if let us say in some theoretical sense, a currency is overvalued, which means that it is very richly priced as compared to where it should be given the underlying demand and supply conditions. What you will tend to see is a lot of imports happening in the country, right? So, there is going to be more imports. That more imports coming in from outside will have an impact on the amount of production that can be done domestically, right? And therefore, the price of the currency can have a significant impact on the domestic economic activity, right? So, what the central banks would ideally like to do is make sure two things. One is the price or the exchange rate is set in such a way that it does not negatively impact the domestic economy, right? It's in some senses a very fair exchange rate depending upon various economic parameters. The second is that there is not, or rather the exchange rate markets are well behaved. What tends to happen, and this is more of a price effect which can have a a sort of a self-sustaining sort of vicious cycle, is that if a currency is depreciating at a very rapid pace, it can erode outsiders' confidence in an economy, right? So in that sense, the value of the currency is also seen as some sort of a barometer of the health of an economy. And obviously when the central banks are thinking about the price of a currency, they also want to make sure that the external view of the economy is good and it's not sort of negative in some senses. So the management of currency objectives can be multiple, but predominantly it can be to make sure that the value of the currency or exchange rate is aligned to economic parameters. And second, there isn't excessive volatility in a currency, which can then create a very vicious, self-fulfilling negative feedback loop for the economy. So I think these are the two broad areas where central banks tend to focus on.
Sure. So again, just going back to the first point you made, if I am a manufacturer, let's say in India, and if the rupee value is low, which means that for $1 I can get higher number of rupees, let's say it falls, then earlier I was getting, let's say just hypothetically, I was getting 80 rupees for a dollar, now I'll get 85 rupees for a dollar. So basically my exports become more competitive because I can, instead of selling it at $1, maybe I can sell it at 95 cents and still make the same profit margins. So I get benefited by a weaker currency. On the other hand, if I'm an importer, then a weaker currency becomes more expensive for me, and so imports become more expensive. And so this dynamic is what central banks will try to manage.
Yeah, so I think remember, I mean, a very weak currency, while it will be good for exports, it will be bad for imports.
Absolutely.
Right? Now, many a times we are actually importing for exporting.
Yes.
Right? I gave the example of crude oil, right?
Yep.
And gems and jewelry. So what you need to keep in mind is that if you sustain a very weak currency for a very long period of time, while you are encouraging exports, you are also actually encouraging exports at the cost of domestic consumption.
Yep.
It might be good to give you a short-term boost in the economy, but then you become too much export dependent for your economic activity.
Yep.
So there are trade-offs to be done over a shorter
Absolutely.
and longer period of time.
And I guess what I hear you say is that you can never, there is a fundamental economic strength. You try to deviate, something else will
play out, right?
So finally you have to kind of come back to,
that's right.
to that level.
So I think, which is where I'm saying that eventually you might actually try and have a very, very cheap currency in some senses, or very weak currency for some period of time, but you can't sustain it for a long period of time.
Yep.
And vice versa. If you have a very strong currency, it will kill your domestic industry and you'll have a lot of import substitution happening.
Sure.
But consumption will be given a boost,
sure.
right? So, which is why I think the central banks over a longer period of time tend to make sure that the value of the currency, and there is a notion of what is a fair value of the currency, is close to the fair value as much as possible over a long period of time, right? So that the economic activity is not substantially impacted either ways because of that.
Understood. One last question in this theme, and then we'll move to some other theme, Neeraj, which is these central banks doing these interventions. Does this have any second order impact on the economy around, let's say, interest rates or inflation, etc.?
Yeah.
Or
it does. I mean, all of these economic variables are very interrelated. I will give you an example of inflation and exchange rate, right? If your exchange rate is, if let's say your currency is weakening, the cost of the imports is going up. And as the cost of the imports are going up, and if you are actually using a lot of imports for domestic consumption, there will be an impact on domestic inflation
yep.
because of the weakening currency, right? And if you are a central bank who is very focused on domestic inflation, you are an inflation targeting central bank, then what will happen is you will be forced to raise your interest rates to tackle this inflation, which in some senses can be an imported inflation, right? So all these variables tend to get interactive, they tend to interact with each other, but in general, I think what the central banks like to do is have a very domestic driven interest rate sort of management strategy, and exchange rate management strategy in line with what the domestic objective is, to make sure that exchange rates are aligned with the economic fundamentals over a period of time.
Great, very helpful.